What do I think about Greenblatt's magic formula where you can get 40, where he's averaged 40% a year over a certain amount of time? I literally could care less. There's always a whoa, dude, what's that guy doing, man? There's always an investment opportunity that looks good, that's done well, that I just, the idea, I mean, look, man, if you know how the markets work, is a bell curve on the markets. You have a median or an average, let's say average, it's not median, it's an average rate of return. It's not median, I shouldn't say that. It's an average rate of return. So you have a bell curve, you have an average rate of return. You will always, forever have some outliers, always on the outside of the averages. Some of those guys are going to be kicking butts and taking names. Some guys are going to be horrible. The problem is you don't know who's going to be kicking butts and taking names in advance. You don't know. You don't know who Joe Greenblatt is before we know that he had 40%. Frank, I don't know if that's true or not. I literally could care less. It's kind of like the Fidelity Magellan Fund. Peter Lynch, who's notorious for running that fund and doing very, very well, no one knew who Peter Lynch was in 1978. The only reason we know Peter Lynch after the fact is because he did so well for the Fidelity Magellan Fund. But does that mean you would have invested in Peter Lynch in 1978? No, because you know who he was. He had a couple picks that were lucky. I mean, he bought the pantyhose maker, Legs or whatever it's called, because his wife was buying them up or something like that. But there's always outliers. It's funny. Excuse me. There's always luck. There's always going to be a Warren Buffett who's either lucky or good, but you don't know until after the fact. That's the problem. You don't know until after the fact, but there'll always be somebody who does well, and there'll always be somebody who looks like a redhead stepchild. Well, Joe why do I keep calling him Greenblatt's portfolio give you 40% a year return going forward? I would highly suspect not. And the reason is because once something does well, everyone flocks to it. And I'm telling you, man, the old dogs of the Dow. Where I first came across this was watching Motley Fool. This is back before this is back when I think they're like 94. And I read the Dogs of the Dow. They had written an article, the Gardner brothers, I think they're brothers, aren't they? Dogs of the Dow. And I said, oh yeah, that sounds pretty good. And then it just blew up. It blew up in a negative way because everyone said, oh yeah, it's like the old January effect, small cap value effect. I mean, once these rules are exploited, they can no longer be exploited. But the issue with a guy like Joe why do I keep calling Greenblatt, is all it takes is a couple stocks to blow up, and in this case, blow up in a good way, and you got a 40% portfolio performance. You just got lucky. You got lucky. Maybe you bought some pink sheet stocks. I don't even know if they still have the pink sheets, or penny stocks. I guess that's what they call them nowadays. Do they still call them the pink sheets? I don't know. But it's luck. And when you're investing, you shouldn't invest based on speculation, i.e. luck. You should invest on investing in dividends, growth, earnings growth year over year. And if you want to go the value route, which is low debt, with this way I would look at Ben Graham way, which is if you could buy a stock less than his cash holdings. So if a cash, let's just use Mailbox Company, Mailbox Inc. Well, I just drove by a Mailbox. So let's say Mailbox Inc. It trades at $5 a share. Its total cash holdings equals $6 a share. If you can find Mailbox Inc. that trades at $5 a share and its total cash holdings equals $6 a share, that's a stock you should probably buy, because its cash is worth more than the stock is trading. Its cash alone. All the other assets are not even being taken into consideration. Just the cash. So you are literally buying an arbitrage. You're buying a stock for less than what its cash holdings are worth. I have a sneaky suspicion you're not going to find any stocks like that right now. I can tell you that. I mean, you might. If you can't buy it, I'm not going to do the research. It bores me to death. So I think nothing on Joel Greenblatt's. I have a hard time saying Joel Greenblatt. It's weird, man. There's like a tick in me. I say Joel Glean. I don't know why that is. Joel Greenblatt's magic formula 40%. And look, it's just a dividend. It's a value-oriented stock process. There's so many value stock screeners. Some are going to work better than others simply because some stocks they're going to buy are going to boom. Some stocks are going to buy are going to get crushed. and you just don't know what's going in advance. So, man, just don't mess with this stuff. Just buy. And this is why, at the end of the day, and this is why, kind of going back to small cap values, I had a good friend of mine who said, I'm just putting all my money in small cap values because historically small cap values have outperformed by far. But the problem is, if you did not have small cap values from 78 to 82, maybe 76 to 82, you did not outperform. You didn't. It's just a 6 years time frame. And so the same thing with Joe Greenblatt. I don't know what his holdings were, but if you didn't buy it, I don't know. But if you miss a small cap value from 76 to 82, I think is what it was, you miss a small cap value extraordinary returns relative to the S&P 500. And I don't know the same thing with this magic formula. If you miss a 2 year time frame, you missed out on the the overall performance. I don't know, but I bet that's the case. I bet there's 2 years there it did so much better. What was the CGM Realty? I have an article on this. The best performing fund in the CGM is a CGM Realty, and I've drawn the blank the dude's name who used to run it. He might still. I think it's CGM Realty Fund. Anyway, that was the best performing fund in the 2000s. However, if you bought it, I have to. I'll revisit this article I have on it that I had printed off. I saved from like 2011. If you bought it at freaking November of 2001 or November 2, I can't remember. If you missed a certain amount of time in that fund, it wasn't the best performing fund. Like, you had to be in there the entirety of the time. I can't remember what it was, but again, it just shows you luck, my friends, is the investor's best friend. Bad luck is their worst enemy. Don't be investing for luck. That's speculation. Just investing for your spreading your eggs, or don't put all your eggs in one basket. Spread your risk. Recognize earnings growth and dividend yields are all that really matters in the long run, and just be happy with a 7% rate of return. Don't get over the top greedy. Just be happy. 7% rates of return aren't too shabby, especially in this low interest rate environment. All right, we'll see you.